Good morning, everyone. Thanks for joining us on the Sasco Digital Podcast. We have a special guest for you today. It's none other than our good friend, our old friend, my brother from another mother. It's Darius Dale. So Darius has emerged as one of the best and brightest market commentators of our time. He's a founder and CEO of 42 Macro. And we have Darius here. So Darius, how are you doing today?
I'm great. That was a very, very kind introduction. And just as you say that, I'm probably about to get every trade wrong for the next couple of weeks. So
I highly doubt that. If your performance continues to hold true, I highly doubt that will be the case.
I appreciate
So
that.
Darius, why don't you talk a little bit about what you do? Talk about a little bit about 42 Macro, and your kind of grid process and how that works.
Yeah, Omar. So thanks again for having me on. I really appreciate this opportunity. I do something very similar to what I think you do, which is, I'm very passionate about helping people understand how the world works. And, I would, sort of put you in the category of helping people understand how Bitcoin and how the cryptocurrency ecosystem works. You've certainly been a wonderful Sherpa for me personally on that journey, and I can't thank you enough for that. And so I feel like that I've been blessed with with the real understanding of how global financial markets work and global macro works, and have built a couple of processes now that have been quite lucrative, both with helping investors manage macroeconomic risk, but also helping them better just understand how the world works, so that they can better start to anticipate big inflection points in the market cycle, big inflection points in the economy that they can proactively take advantage of.
And teaching you about Bitcoin, you were such a quick study. You picked it up like that. You really understood the risks. You understood the volatility. You saw the volatility as a feature and not a bug.
Yep.
When you think about Bitcoin, and when you think about Bitcoin emerging right now as an asset class that's getting more and more attention, what are some of the things that investors like that you're providing value to through 42 Macro? What are some of the things that you'd like them to understand about Bitcoin?
Yeah, so that great question as well. So I think the number one thing with respect to what we do at 42 Macro, which is help investors fold Bitcoin into a more traditional, more institutional oriented sort of asset management approach. Obviously, I think a lot of investors, particularly my age and younger in the younger communities, they're sort of YOLOing and living out there on the risk spectrum with respect to their cryptocurrency allocations, and that's totally fine. That's probably what you should be doing in a raging bull market for risk assets in general at that stage of your life. But the reality is there are so many investors that are at or near retirement in traditional products, that maybe not, that maybe can't take advantage of that. Certainly don't have the risk tolerance, the risk profile to be YOLOing it out there in Dogecoin or whatever the more exotic version of that is these days. So what we try to do at 42 Macro, and again, everything we do is through the lens of what we call our grid grid regime process. What we're trying to do is segment the economy into four divisible states that are very consistent across time in terms of perpetuating certain types of market responses. So you have Goldilocks, that's when growth and inflation, or growth accelerating and inflation is decelerating. You have reflation, that's when both growth and inflation are accelerating simultaneously. You have what we call inflation, what most people call stagflation. That's where growth's decelerating and inflation is accelerating. And then lastly, you have deflation, which is where both growth and inflation are decelerating simultaneously. So, the key takeaway for that whole entire process is really just, the asset markets behave a certain way in each of these environments, and that behavior is very consistent across time. And what we're trying to do is fold cryptocurrency into that ecosystem, and lo and behold, it trades very similarly to many other commodity type exposures, obviously with a lot more volatility, but a little bit less covariance for the most part. But generally speaking, it is something that can be risk managed through the lens of a more institutionalized kind of quote unquote normal investment framework.
So you just mentioned grid, and what I love about 42 Macro is you apply a consistent process to evaluating, different asset classes, different commodities into that grid framework. Where are we right now as we stand? We're shooting this in November of 2021. So which one of those regimes are we in right now, and what do you see us heading into the next couple of weeks and months?
Yeah, great question. So I'll share my screen here. One of the things we do at 42 Macro, we put out a deck every month, usually right after the jobs report, just updating our economic views on the economy. Where's the U.S. economy going? Where's the global economy going? Europe, China, et cetera. What are the key discussion topics? What are the hot button debates, if you will, out there that we need to have an informed view on? And then ultimately, sort of, we wash that out into what does this actually mean from a portfolio construction perspective? And so, in terms of answering your question, Omar, where are we right now? It's almost like we have to explain where we're coming from for where we are right now to make a little bit more sense. So, kind of we'll walk you through. As I mentioned, Goldilocks is when growth and inflation are oh, did I lose my pen here? Oh, I gotta say. There we go. That works. That's so Goldilocks for growth is accelerating, inflation decelerating. Reflation is when they're both accelerating simultaneously. That's inflation down here at the bottom right, and then deflation. That's for both slowing simultaneously down there at the bottom left. And so, this was COVID. COVID kind of slammed us at the bottom of this chart. You no longer see those plots right there. But we were way down there in terms of the speed of the deceleration of both growth and inflation. We bounced back up into reflation and have really been there for a really extended period of time. I mean, starting in July of last year all the way through August of this year, it was very clear that the economy was trending higher and inflation was trending higher as well. We had a little bit of blip down in both in the month of September. That was obviously the Delta variant, having an impact on economic statistics. But ultimately, what happened? Now we're kind of at this place where growth is kind of very modestly trying to bounce here in Q4. But the reality is, in conditional probability terms, the highest probability outcome is one of stagflation, is one where growth continues to decelerate on a trending basis, and inflation continues to accelerate on a trending basis. And then, in terms of where we're headed, that's all likely to give way to a trending environment where both growth and inflation are decelerating simultaneously. It's a lot easier to see that in a chart, or at least in a time series rather. So this is kind of you are here with respect to the U.S. economic sine curve for growth. And so obviously the outlook as we progress into 2022 is one of deceleration. I don't think that's particularly a novel concept. It's really just about the speed of deceleration and how that's likely to particularly impact asset markets. In our opinion, right around the kind of the mid to late Q1 is kind of where a lot of that market risk should be concentrated in terms of a bigger deceleration. And then lastly, we're kind of at the peak of the inflation sine curve. We might get one more month of uptick in terms of forecast here or there, but I'm not too concerned about that. I think the reality is what investors have really started to move into pricing in as it relates to the long and the fixed income market, the tightening we're seeing and the compression we're seeing in treasury yield curves is this outlook for inflation, which is obviously one of disinflation from an albeit extremely high level heading into next year.
So, if we're moving into a deflationary environment heading into next year, for those that are long Bitcoin, that doesn't sound like a scenario. That doesn't sound like an environment that's very friendly for price appreciation in the Bitcoin market. How should Bitcoiners position themselves if we do see the early signs of deflation? Would you say that they should lever out of Bitcoin into more traditional asset classes or take on additional risk? How do you see Bitcoiners particularly position themselves to protect their wealth?
Yeah, great question. So, again, everything we do is through the lens of that regime segmentation process. And so one thing we've done pretty well as anyone on Global Wall Street, which is understand how asset markets have traded with respect to these economic dynamics. What's happening in the economy from a rate of change perspective with respect to growth and inflation. What's happening with the economy from a perspective of what the Fed's policy rate is doing, what the balance sheet's doing, what fiscal policy is doing, and understand how each of those dynamics really, going into the granularity of scoring those dynamics vis-a-vis, things like annualized expected returns, percent positive ratios, volatility, covariance. These are all the key descriptive statistics that anybody on the buy side is clearly using to guide any sort of legitimate investment process. And so, with respect to Bitcoin. Bitcoin, as you can see, so the overall back test, and again, one thing we do with our cryptocurrency back test, and I think is pretty appropriate, is we actually winterize the sample to the start of 2017. That's my own personal sort of observation, but in my estimation from watching how the asset class trades, it seems like there's a lot of institutional adoption in 2017. It seems like there was some in 2013 as well, but I would argue the asset class became much more widely adopted across kind of different styles of investors in 2017. So keep in mind that these back tests are considering monthly observations from that period forward, starting in January 2017. And so what we've noticed in the 17 months that we've been in deflation in since that time period, the average annualized expected return is 10%. So on average, you're losing about 10% annualized in each month, each of those 17 months that Bitcoin's in deflation. There's obviously some much worse back tests if you look at it when the policy rate's not doing much. You look at it, ironically, when the Fed is quantitative easing in deflation, because that obviously means the situation is quite bad if they're already quantitative easing, as opposed to using the data to get them to a state of quantitative easing. So that's a big issue. It's certainly a big issue in the context of fiscal tightening next year. That's something we already have baked into the cake, irrespective of the size of the Biden agenda that we're likely to see come out of D.C. over the next few weeks. Irrespective of that, the size of the package, the size of the budget deficit are both likely to shrink relative to where they were in the first half of this year and in fiscal 21 in particular. And so to answer your question, Omar, I do believe that Bitcoin and by extension, you look at Ethereum, the back test for Ethereum is quite similar. It's actually quite more negative for deflation, different styles of deflation, if you will. So that's something we're quite concerned about heading into next year. Although I do believe that we won't necessarily have to worry about that in terms of putting the trade on until we get sort of later into Q1. And the reason I say that is because it's very unlikely that we see net liquidity inflect lower into the second quarter. This is a very important chart. So we all know that the Fed's balance sheet, the growth of the Fed's balance sheet has been something that's carried asset markets higher, particularly risk assets, stocks, commodities, cryptocurrencies as well. And so that relationship is something that we don't expect to break down anytime soon. So as a function of that, what we're really trying to do as investors is, read the tea leaves on the economic data to understand whether or not the Fed might actually start to accelerate tapering, to understand when is the Treasury going to come back into the market from the perspective of taking down a lot of this overnight repo, and ultimately the impact of those two dynamics, specifically as it relates to the projected path forward for the blue line. Eventually, the blue line is going to inflect lower. We already know tapering is going to take it from an exponential curve to a logarithmic extent, and at some point that logarithmic extent is going to start to have a negative slope. So it's our job as investors, as it relates to booking gains in what has been a historic run in Bitcoin, booking gains in what has been an historic run in stocks, to identify that kind of that threshold, that time period where we would expect net liquidity to inflect lower. And again, how we're calculating net liquidity is the Fed's balance sheet minus the change in the Treasury general account balance as a proxy for the overall amount of liquidity coming out of DC, coming out of both the monetary and fiscal authority in the U.S. And so in our estimation, that's a 2Q event in terms of the amount of time it's going to take for the Treasury Department to take down $1.3 trillion in overnight repo with this incremental borrowing, and ultimately the pace of tapering that we expect, which we do believe might actually start to get accelerated in December or January. In January in particular.
Yeah, it makes a lot of sense. A lot of anyone that has been following the markets from at least 2008 have recognized that with Fed easing and the loose monetary policies coming from the Fed, it's meant a lot for asset appreciation. I want to go into briefly what do you see as being the key triggers for the Fed really tightening up the policy? I know, or maybe go into the detail of how you believe the probability is that we're going to see some tighter policies coming from the Fed. You say that we're probably going to see more easing, but you also alluded to some tighter policies that could impact asset price appreciation. So how do you derive those probabilities?
Yeah, absolutely. So you hit the nail on the head. Probabilities is the word, my friend. So when you look at something like our U.S. inflation forecast, I got to erase this a little bit. Look at our U.S. inflation forecast. You can see it a little bit better. What we're talking about is, our model is currently suggesting that 6.2% in October is in fact the likely cycle peak. It's not a slam dunk that it's a cycle peak, because you're still seeing a decent probability of accelerating inflation in December as well, in November, December as well. But the reality is, when they're sitting around the table in their mid-December meeting and their late January meeting, they're going to be looking back at data that sees a couple of 6 handles and maybe even potentially 2 or 3 6 handles on headline CPI. But that to us, that's more of a sideshow. What really matters from the perspective of the Fed is where core PCE is. That's core PCE. That's a line item here. That's That's the line item here in their model. And right now, the most recent data point through September is 3.6. We're going to get the next data point, and it sort of we get the next data point tomorrow, I believe, November 24th. Most likely to see that jump up to somewhere around 3.8%. Our model for core PC specifically, because again, what we're trying to do is forecast headline CPI and use all these different factors, projecting all the different factors and the rate of change of those factors, and feed them back and through to headline CPI, because that back tests the best as it relates to predicting dispersion within across asset markets on a more consistent basis. But we actually have forecasts for core PC as well. And the reality is the sort of cycle peak for this chart is actually in November, at least according to our models currently, which is around 4%. And so if we get a 4% handle on core PCE in the month of November, that data is released on a full lag relative to the observation period. So you're talking about in late December heading into the start of the next year, it's very likely we see a 4 handle on core PCE, and we think heading into the Fed's January meeting, it's going to be very difficult for them not to accelerate the pace of tapering in the context of having that print in hand, having 2 or 3 6% headline CPI prints in hand. In our opinion, I think that'll just be too difficult for them to push back against.
Perfect. Okay, I want to switch gears a little bit. Let's go back to Bitcoin. Let's focus on, I want to just kind of hear from you about, you've been really focused, not focused because you're focused on a broad macro view, but you've been, late last year, Bitcoin kind of hit your radar, and you spent a lot more time on understanding it. What surprised you the most about Bitcoin, whether it's its history or, currently, what you're seeing? Is there anything that stands out in terms of, just something that you didn't even consider before that you've learned over the past year or so?
Yeah, I would say the resiliency of the asset class. I mean, obviously, it took it on the chin going back to the spring of this year with respect to the China ban on I want to say mining, I believe. Yep. I would have thought something like that, certainly with respect to my own edification of the cryptocurrency space at that moment. I was under the view that could have been the end of the bull run. And quite frankly, I did develop the view that might have been the end of the bull run. We certainly saw a broadening out of the end of the bull runs for a lot of commodity market speculation, or at least for a time.
You weren't the only one,
for a
Darius.
period of time. I mean, yeah, no, totally. Look, I think it's very fair, and we have models to track this as well. I mean, one thing we look at, and so I guess one thing that's very different and unique about our process that most people don't have, but I think over time they will increasingly have as a part of their processes as well, which is a clear and distinct separation from market analysis and economic analysis. Those are, in our opinion, should be and should always remain two separate processes. You have to separate church and state if you're trying to become a better investor, because the reality is at various intervals, church might be right on a forward-looking basis, and in other intervals, state might be right on a forward-looking basis. And so what you're trying to do, or we're trying to do at 42 Macro, is actually sit at the intersection of church and state, identify which changes in the behavior of those two particular models, those two particular frameworks are actually investable, and whenever they're investable together, we actually make portfolio construction decisions. Everything else is we tend to treat as noise, or at least more color as it relates to the evolution of the process. But going back to the answer to the question, this is early June here. Sorry, not that one. This prior peak in the reflation, in sort of the probability of reflation being priced in asset markets, peaked in early June, and we called that peak out going back to in terms of our conviction score reading. That was a 99th percentile reading in terms of the market pricing in reflation. And so the reality is there's only one way to go down from there. So we made a pretty heroic call to book gains in some very consensus reflation trades, particularly in the commodity space, in the small cap space. The types of exposures people really go to the source for, to the extent that they're looking for higher volatility ways to play reflation. I thought in the context of making that call and seeing Bitcoin really kind of collapse, we thought it might have been a leading indicator for a lot of the unwind of the pure reflation trades that we saw kind of from this peak of the cycle all the way through kind of late August, mid-September. It was like a one-way ticket down for if you were long energy stocks or material stocks or copper or hot lumber, all these sort of like pure reflation type exposures. It was obviously a very painful summertime for a lot of those types of exposures, and cryptocurrency, Bitcoin, notwithstanding. So what we saw was in that May to sort of May to July, I guess, drawdown. It was like, okay, maybe this was a leading indicator that this whole thing is likely to come unglued, but that was obviously the wrong call. We wound up buying Bitcoin back, I want to say, in August anyway, but it was a very clear that, hey man, this thing has some serious momentum if it can survive the biggest economy in the world with probably if I had to guess, the largest number of people who own Bitcoin, basically banning it, or at least trying to ban it from various aspects of their financial sector. So to me, I thought that was a really powerful story in the sense that, man, this thing is, one, it's here to stay. This is not a speculative vehicle. This is a very serious long-term institutional investment vehicle that I think everyone's sort of realizing now. But more importantly, look, the blockchain works. It's not like somebody got in the room and said, hey, look, we got to fix this. We got to avoid China. We got to do this. We got to ring fence China. No, it just happened on its own.
Yeah.
And to me, I think that's one of the most powerful things that's probably ever happened to human society. We'll go back and read books on this 10 years from now, but I think it was one of the coolest things ever.
Yeah, and it really validated Bitcoin's, we always talk about Bitcoin being anti-fragile and being able to resist, state attacks. And I don't think that was a real state attack. I think it was just, it was a real change in a lot of the dynamics as it relates to mining. Probably the biggest one in Bitcoin's history. Going back, I think the biggest, you had the Mt. Gox failure. That was huge, right? You had a lot of people that lost a lot of their Bitcoin in the Mt. Gox failure, and that caused the price to tank back then. You had, but very rarely do you see like a massive, kind of trigger that causes, an amazing amount of sell pressure into the Bitcoin market, like we did when we saw the mining ban. And I just thought it was a wonderful proof point to the resilience, like you said, of the asset class, and prove that there's going to always be some demand from somewhere, and there's this kind of floor of support around the asset class. And we found that floor was at around the $30,000 price level. And if I look at your reflation, chart that you just showed, the price action pretty well correlates to, that reflation, where we saw a peak in the, May-June timeframe, right? And then we saw a downturn, and then we saw, where we are right now, where it's, it's back up and it's kind of consolidating around the, 55 to 60K level. That's, that's exactly, that's kind of what we saw through the summer. So it speaks to the resilience of the asset class, and I think proof points like that give investors confidence that, they're investing in something that's really unique and different than, anything else that they might be used to.
Yeah, no, totally. It's new, unique, it's different, but one thing that is not different is investors' willingness to speculate. In the one thing that will never change with respect to financial markets is fear and greed are the dominant drivers. Yeah. Whenever things are good, people tend to want to take more risk and make more money. When things are bad, people tend to want to do the opposite. There are times to do both. That's what our process is designed to do, is to help investors understand, hey, when you're in one of these two boxes, you need to be taking more risk. This is a disinflationary tech-style-led risk, and this is more of a inflationary commodity-style-led risk. And then when you're in these two boxes, you want to be taking less risk. This is a disinflationary bonds leading type risk, and this is more of an inflationary, stagflationary. You can get long, things like energy and food and Bitcoin type risks. And so the reality is, it's the game is easy if you have perfect foresight into where you're going to be in this process. Obviously, you're never going to have perfect foresight in terms of what's going to happen economically over multi-quarter period of time, multi-month, multi-quarter period of time, because the reality is things are always shocking the economy that have different various leads and lags. And there's also exogenous events. This thing called COVID kind of crept up out of nowhere at the beginning of 2020, and obviously it's been with us since as it relates to its impact on the economy. It's had quite a few very interesting impacts on the economy. On one hand, it's made inflation, ironically, much higher on a secular basis. In our opinion, we've done a tremendous amount of math on this. One thing we look at, this is our secular inflation model. What we're looking at are sort of all the primary drivers of why we got to this sort of trending disinflation since the kind of early 1980s all the way through the end of the last decade. What caused that disinflation? All these things that certainly cause things like automation, demographics, the budget balance, and declining money velocity. All this stuff basically contributed in some form or fashion to inflation going from an average of 5% in the 70s to somewhere we're just shy of 1.8% in the 2010 to 2019 decade. And so the reality is, COVID's had a pretty meaningful impact in terms of actually accelerating some of those dynamics, making things a little bit more disinflationary. But on balance, the reality is, on balance, just judged by the number of positive values in this table, on balance, and what those numbers denote is the delta adjusted Z-score for the latest value relative to this 2010 to 2019 sample. So, for example, the fiscal balance as a percent of GDP, minus 12%. That's on a delta adjusted basis. That's a 3.3%, a 3.3 sigma move that in terms of contributing to inflation. So on average, you would expect the stationary mean of inflation to be 3.3 sigma, a z-score of 3.3 standard deviations higher than it had been in 2010 and 2019. So when you do all that math and you add it up on a raw basis and a weighted basis, I think the weighted basis is more relevant in terms of my own identification of what actually drives inflation more. You're talking about a stationary mean of inflation that's about 80 basis points higher to begin with. And so what I mean by that is that, hey, inflation is a sine curve, right? It's a periodic function. It doesn't go straight up. It's never going to go all the way up to the top of the chart. It's never going to go all the way to the bottom of the chart. But the reality is that periodic function has a stationary mean. That stationary mean was 1.8% in this most recent time period. We're talking about a stationary mean that's at least 80 basis points higher already, just based on what's already happened since the beginning of COVID. And I would argue there's something called ESG out there lurking in the balance that might actually be a little bit more inflationary. That's hard to it's hard to quantify now and stick it in a model. But I think we all kind of agree that it's going to be an inflationary impulse rather than a deflationary impulse. So I think the net result of this analysis, going back to the table on slide 39, we're talking about 80 basis points higher already. We could be talking about 100 to 150 basis points higher when it's all said and done, once you factor in ESG. So that's a big deal.
That's incredible.
That's a huge deal in terms of this random thing that came out of nowhere.
And you mentioned earlier, I mean, really reading the tea leaves is what it's all about, and trying to understand what's happening, in the world, and, processing that and providing that in a form that's digestible is something that you do very well for your followers and for your subscribers.
Thank you.
About reading the tea leaves, just yesterday, President Biden renominated Jerome Powell, but also announced that the vice chair is going to be Lael Brainerd, who, as we all know, is a modern monetary theorist. Does that lend you to believe that we're going to be seeing more consistent inflation? And you just mentioned ESG as a driver for more persistent inflation. Talk about that a little bit. We know that the Fed has so much influence on the markets, probably the biggest influencer of the markets. How do you see that announcement that Lael Brainerd is going to be the vice chair? I read it as potentially she's going to at some point succeed Jerome Powell, but I'm interested in your take on it, and and what you kind of see, lurking in the tea leaves.
Yeah, it's so interesting you said. So I have the same view as you. She's very likely to succeed Jerome Powell as the Fed chair, barring any health or odd consequences or anything like that. Actually, no. Let me say that back. I think it's pretty clear that that as things are currently going with respect to Joe Biden's approval rating and the general social discontent with respect to inflation, that you might see a guy named DJT return to the White House in 2024. Or at least in 25.
That's zooming out a little bit more, right?
Yeah, and so to assume that Lael Brainerd is the next Fed chair, I think it'd be premature in the context of that development. But assuming let's all things being equal relative to today's starting point of who's kind of running the show in DC, which again I don't believe has a lot of staying power, at least at the current juncture. It's very likely she becomes the next chair. But the reality is the space between her and Jay Powell is actually quite limited with respect to their political objectives or policy objectives. They're both hyper focused on the labor market as sort of like the key driver of monetary policy, and for good reason, right? I mean, if you have a view, and again, they're basing their view on their forecasted views on inflation, which may turn out to be extremely wrong, and obviously that will create a lot of policy error as it relates to having to accelerate the pace of tapering and tightening throughout the course of next year. But let's take their forecast, at their word. Let's say they're clearly not going to be perfect. Nobody's forecasts are. Let's just say they're somewhere around 2/3 right. So inflation's transitory, but it winds up sticking a little bit longer than we initially expected as a function of consumer balance sheets being very robust heading into the holiday season, where people can't get stuff off boats, right? They're all stuck at the port. And so that's kind of your key takeaway there. But as it relates to why they're so dovish, these two individuals, Jerome Powell and Lyle Brainerd, it's really just a function of the shortfall in employment. This chart here at the upper panel shows that the employment to population ratio is still 230 basis points off of its pre-crisis peak. That's massive. The prime working age labor force participation rates, so in individuals who are 25 to 54 years old, that's 130 basis points off of its pre-crisis peak. So that's probably even more startling in the context of what we all consider to be a very robust labor market, particularly from the perspective of college-educated individuals. And then lastly, the female labor force participation rate, which is 180 basis points off of its pre-crisis peak. So this is why they're so dovish. They're sort of trying to do their best job of ignoring the intensity of inflation right now to allow for more healing in the labor market to take place as a function of their easy monetary policy. But the reality is the market no longer really wants to wait on them on that. The market is effectively saying, no, we won't take your inflation forecast at face value, and we're actually going to price in more than three. We're starting to get more than three. It's technically three, but more than three rate hikes in 2022. Now, mind you, this is a FOMC board that just most recently in their dot plot said we're only going to do maybe one in 2022, right? And so three is a big difference than maybe one, and 3 also implies in terms of the timing with which they're likely to space these things out. It means that they're going to have to accelerate tapering and be done with tapering before their current path of ending in June. We don't believe that they'll end in June. We think they'll end sometime in early to mid second quarter as a function again of accelerating that process. I don't think they can survive a January 2022 FOMC meeting with a 2 to 3 6-handle headline CPI prints and a 4-handle on core PCE without accelerating tapering. All the noise we hear around tapering, quantitative easing right now is only going to accelerate once we get those prints in hand. So this chart, in our opinion, is wrong because again, I don't think they're ever going to get to 3 rate hikes. But I think the market will look them in the whites of the eyes and force them to tell us no.
Right.
This chart is going to have higher highs until the Fed eventually says, no, we're actually just not going to do this. We're going to create some distance between the final tapering, taking in terms of taking the purchases to zero, and then ultimately when the first liftoff is. So I tend to be somewhere in between the market and the Fed's, kind of dot plot relative to where it was in the most recent update. But ultimately, I think I see what the bond market sees, which is all these rate hikes are being borrowed from 2024. It's not like the economy's just in this wonderful place where, oh yeah, sure, we can hike rates to just get inflation down. No, what this market is saying is the flattening of the yield curve, which is flattening across the curve, no matter how you slice and dice the yield curve, 2s, 10s, 5s, 10s, 5s, 30s, 10s, 30s are all going down. And to me, I think the signal from that, in our opinion, is one that's confirming of our view that disinflation and slowing growth will be the big themes of next year, along with the fiscal drag that we're going to see in terms of fiscal policy. And ultimately, that leaves the economy in a much more shaky place by the end of next year than we are currently. So we just don't think that they're going to have the economic tailwind to policy to accelerating a rate hike plan between now and then. So as it relates to Bitcoin and risk assets in general, there's going to be a problem at some point in the early part of next year. I want to say mid to late, or at the earliest, I would argue mid to late Q1. Sometime in the second quarter is probably the latest, I would argue as well, where asset markets have to really fully price in, going back to this site, they have to fully price in what this ultimately means in these terms. Because if the markets are really freaking out about them tightening policy rate at an accelerated pace in 2022, they're going to start to look out into 2023 and take down earnings expectations, take down growth expectations, and all that stuff. It's not going to be good for risk assets, Bitcoin included.
Right. That's excellent. That's a wonderful analysis, Darius. That was
Thank you.
Really. I love that you take a really process-driven approach to analyzing the markets and providing your, the people that follow you with that kind of insight. So. Always a pleasure, Darius, speaking to you. Where can people find you? I know that you have a Twitter account. Why don't you just talk a little bit about where people can find you and how they can get in touch?
Absolutely, man. Thank you again. I appreciate being on with you guys today, man. This is you have an awesome program. You yourself, I said this to you over a year ago now when you were sort of guiding me up the mountain on my Bitcoin education. But I said, man, you got to charge for this. I was like, you're the only person that I can, from what I can see on Twitter or Glean, that has a real sort of data-driven, intense, kind of real thoughtful framework around, understanding Bitcoin risk. I think a lot of people are really good at marketing Bitcoin, and have made great businesses out of it. There's nothing wrong with it because it's obviously working. Pull up a chart of Bitcoin, but the reality is, I think, someone like you, the real value to what you bring to the table is helping investors understand that risk, how to warehouse that risk, and ultimately how to risk manage that risk across the cycles, because it's not always going to be a straight linear ride up in the Bitcoin price chart. And I think one thing we do at 42 Macro is sort of do that with broader asset class exposure, equities, fixed income, commodities, currencies. How do all these different investment vehicles fit into your portfolio as a function of where we are in the investment cycle, which itself is a function of where we are in the bottom-up economic cycle. So answering your question, where can investors find me? So obviously 42macro.com is our website. Come check us out. A ton of content on there in terms of kind of coming up to speed as it relates to our process, as it relates to kind of some of our latest views on a lag. We respect our paying clients, obviously. And then on Twitter, 42macro, at 42macro is our firm Twitter account. My Twitter account, I'm quite active in terms of both publishing certain types of research and insights. We do this thing called the Macro Minute every morning. That's really popular in terms of just walking through everything that's changing in global macro that matters to your portfolio, and ultimately providing some probable range analysis for those of you who are more shorter term with your trading activity. So that's really popular. And so my Twitter handle is at 42macro ddale, DDALE. That's at 42macro ddale. Thank you guys for checking us out.
Amazing, Darius. Thank you. And just to touch on what we're doing at Sasco Digital, you kind of alluded to it a little bit. Is we focus on Bitcoin. We specialize on the asset class. No different than other specialists that specialize in oil, natural gas, and other types of commodities and asset classes. But what we love about Bitcoin is that it has an open blockchain that anyone can interrogate, and you can see from the blockchain, what's happening, what the activity is indicating, and we use that to kind of forecast what's going to happen with Bitcoin. It's very hard to do on a short-term basis unless you're using technical analysis. There's a lot of people using technical analysis. They're not looking inside, and they're not looking at exactly what the behavior is of the Bitcoin holders, the short-term holders, the long-term holders. So we analyze that, and we're able to make some pretty good predictions about what's going to happen in weeks and months rather than hours and days. So yeah, I appreciate I appreciate the kudos from you, Darius. That's great.
Yeah, you look, you're a data-driven guy as well, and I think that's the only way to really go, right? Like, what's the alternative? Like, the alternative is what macro used to be, which is bunch of smart guys in a room with the black box, and looking. It's I wouldn't go that far because I'm going to get some emails in my inbox, but I'll go as far as to say is, look, the game was a lot easier back then.
Yeah.
Right. Like there was less retail participation in markets, through ETFs and things like this. You could call up a central bank. You could call a company pre-Reg FD. The game was just easier to make money. But now, sort of the advent of all the sort of digital information, the proliferation of information, it puts the onus on every investor to have a real systematic process to actually absorb all that content, absorb all that information, actually know what to do with it. And then ultimately, at the end of the day, investing will always come back down to your ability to be disciplined, your ability to check your own fear and your own greed.
Absolutely. Couldn't have said it better, Darius. Amazing. Thank you so much. Have a great day, Darius, and hopefully we'll talk to you again soon.
Cheers, guys. Thank you.
Thank you. Take care.